Hello all, my name is Niels Winther, and I'm a CPA, and I'm as much a member of the Kaiser family as you all who are listening here today. You see, my dad opened the eye clinic at Kaiser Sunset back in the 1950s. I was born in a Kaiser hospital, my children were born in a Kaiser hospital, and my grandchildren were born in a Kaiser hospital. I've been working with the Kaiser system my whole lifetime and have carried that into my professional life. I've been guiding and advising Kaiser physicians for over 20 years. I prepare the income taxes for physicians with special emphasis on partners in the Southern California Permanente Medical Group, known to most of you as SCPMG. I'm financial advisor to many SCPMG partners, and we manage the investments and structure the portfolios to help our SCPMG partners down the road to financial success and retirement dignity. So after a couple decades of doing this, I've come up with a few suggestions that can help you with charting the course to Kaiser financial success.
So what are our objectives? Let's figure that out together. Where you are, where you want to be, and what you want to do when you get there. So today, you're a resident. You work long hours, there's lots of pressure, very little praise, and not a lot of money. You ask, will this ever change? The answer is yes. So, what's going to happen? You're going to get hired into a real job, you're going to start earning a real salary, and you're going to start spending that real salary. You're going to start buying cars, homes, toys, and stuff. And you're going to start paying real taxes. How awesome is that? Is this your recipe for success? Or are you headed for disaster? So, what happens to the big spender? You wind up having to work your butt off, working overtime shifts to support your new lifestyle, your new spending patterns, and your new debt. Quality of life goes into the toilet. You can't enjoy what you got because you're working so much. Work takes its toll on your family and your health. So we ask, how do I keep this from happening to me? Well, you follow our action plan for success. So what is the next step in the action plan for success? You got to establish a game plan to follow, then implement that game plan. You have to complete your residency, get hired by Kaiser Permanente, and become an associate, which is an attending physician. Set your goal to become a partner in SCPMG. Again, the Southern California Permanente Medical Group. Set up a plan for savings and retirement. And you need to properly plan for income taxes. The first thing to do is complete your residency and get hired. In family medicine, there's a 3-year residency, and your income's about $40,000 a year. For the first-year resident, this is your first year of internship. You pass your Step 3 boards and apply for a California physician's license. Then there's 2 more years of residency. While a third-year resident, you pass your family medicine or specialty boards, obtain a certificate, such as to become a board-certified family medicine physician, go on your interview and get hired as a Kaiser Permanente associate and complete your residency program. After being hired, you can start working as an attending physician. Okay, the associate interview. What can you expect? It's typically in the 3rd year of residency. You get a same-day interview with the physician in charge, the PIC of the clinic. The PIC hires you. The chief of family medicine or your specialty sets the salary, and you'll get notified in a couple weeks of the decision. Complete your residency in June, and you can be working as an associate as soon as July, and your income is going to be about $140,000. So, working as an associate, what can you expect? You'll continue to receive a salaried paycheck and a year-end W-2. Your higher income means you'll be paying higher taxes. you'll be in a higher tax bracket and you'll probably be subject to alternative minimum tax and limited itemized deductions. You see, the December 2017 Tax Cuts and Jobs Act has imposed severe limitations on itemized deductions. State income and property taxes are limited to $10,000, and if you buy a new home, mortgage interest is limited to loans not exceeding $750,000, and unreimbursed employee business expenses have been eliminated. You'll be required to complete CME. That's continuing medical education. You'll have to do 50 hours every 2 years to renew your license. And you will be required to make a Keogh contribution election within 180 days, 6 months, of your associate hire date. So, a mandatory Keogh election? What's a Keogh? A Keogh is an HR 10 retirement plan for the self-employed that allows contributions greater than can be contributed to a tax-sheltered retirement, the TSR, which is Kaiser's equivalent to a 401k salary deferral plan. The Keogh is a retirement contribution only available to partners in SCPMG. Remember, the election must be made while you're an associate, even though the contributions can only be made after becoming a partner. Keogh contributions can be made only at 3 rates, 13%, 10%, and 0, which is the percentage of your earned income, typically referred to as 100%, 75%, or 0. This election is irrevocable. Once it starts, that's it forever. You can petition to get it stopped, but you cannot petition to get it increased. So making the mandatory Keogh election, is there any advice on what to choose? Based on conversations with numerous SCPMG partners, if they could do it all over again, which they can't, they would choose 100% contribution, the 13% of earned income. Partners choosing 75 wish they had chosen 100. Partners choosing 0 wish they hadn't. Remember, this is an irrevocable decision. Why is the Keogh plan so important? The contribution is pulled out of every partner's paycheck and qualifies for a tax deduction in the current year. And contributions grow pre-tax on a tax-deferred basis. How much is the Keogh contribution? The max 2017 contribution was $35,700, and the max 2018 contribution will be about $36,300. For a 75% contribution in 2017, it was $27,000, and for 2018, it'll be about $27,500. In addition to the Keogh, Kaiser offers a TSR 401k plan. This is also available to associates as well as partners. The 2017 max contribution was $18,000, and the 2018 max will be about $18,500. Bear in mind, retirement plan contributions are not accessible. Severe penalties apply to distributions before 59.5 years old. You touch this, and this will be the most expensive money you will ever spend, subject to a 50% penalty tax. So where are the plan contributions invested? Both TSR and Keogh contributions are invested into a handful of selected mutual funds that Kaiser determines and offers to their employee participants. Keogh contributions, however, can be placed into a self-directed option, which we at Winthco Wealth Management can fully manage for all our SCPMG client partners. Through the self-directed option, we pick from over 20,000 mutual funds and offer our clients the most favorable mutual fund options. TSRs, on the other hand, cannot be fully managed, but we can help you with investment selections and fund monitoring, as well as fund rebalancing as economic and market conditions change. So what's the next step in our action plan for success? Well, you set a goal to become a partner in SCPMG. After 3 years as an associate, you will be eligible to become a partner in the Southern California Permanente Medical Group. You must be voted into the partnership by the existing partners. Preliminary partnership votes are taken on prospective partners at the 12 and 24-month intervals to gauge their partnership potential. Remember, this is performance-based. Prospective partners must receive at least a 2/3 majority of the votes to get in. Acceptance into the partnership is not automatic. Some people don't make it. At this point, your income is about $240,000. Partners' typical income ranges from $250,000 to about $400,000. So, yay, you become an SCPMG partner. What takes place now? Well, the absolute biggest change is that you are no longer an employee. You become a self-employed partner. Those who are self-employed no longer receive a W-2. Those who are self-employed no longer get income tax withheld from their paychecks. Those who are self-employed have income reported on a Partnership Form 1065 Schedule K-1. And those who are self-employed pay their taxes by sending in quarterly estimated tax payments to the Fed and the state. You report your income on a Form 1040 Schedule E. You become liable for not only income tax, but also, and in addition, you become liable for self-employment tax. That's the self-employed person's equivalent to Social Security. You get to pay and deduct your own business expenses, even after the change in the new tax law. And you'll find that your disposable income actually goes down. So how do you deal with this? Your tax reporting obligations just became incredibly more complex. So what do? Who should you go see? How do you know how much to pay in? How do you write off the business expenses you now have to pay? You need a competent, qualified CPA who is extremely familiar with your unique situation to provide you tax and investment guidance. An H&R Blockhead just won't cut it. So you'd better properly plan for taxes, because you'll get a K-what? Partners at year-end receive a K-1, which reports each partner's share of SCPMG operating income, imputed income, interest, dividends, gains and losses, and tax credits, as well as self-employment income. Income tax and self-employment tax is assessed based on the K-1 amounts, not on a W-2. Tax is expected to be paid to both the Fed and the state quarterly. Penalties and interest will be charged if you don't, or if you underpay. So now you start making estimated tax payments. But you got enough in your bank account? It's bad enough knowing that estimated tax payments have to be paid quarterly. But how do you make sure you have enough money to write checks that might be as much as $15,000 to $20,000 per quarter? You need to establish a paycheck withholding system. Go open a savings account or investment account in addition to your existing checking account. Have your paycheck direct deposited into that new account, then transfer to checking however much is needed for your personal living expenses, leaving the rest so that when quarterly tax payments come due, the money left over is there to pay the tab. You might ask, is this really necessary? You'd be shocked at how many partners get behind on their quarterlies. So you'd better properly plan for taxes. You've just been given a system to make sure you can pay your quarterlies. But how much do you pay? This is a science in and of itself. You need someone who knows this partnership, its income, and its deductions to help you minimize your income taxes. This is imperative when you become a partner, but it's equally as valuable and important today as when you become an associate. Next, the game plan for savings and retirement. Kaiser offers its SCPMG partners a pension retirement. This is referred to as the Common Plan, based on the following formula: 2% per year for the first 20 years, 1% per year thereafter. After 30 years of service, this is equal to approximately 50% of your monthly salary. And you must have 10 years of service minimum to receive benefits. So you think this is enough? Partners typically say that there is no way they can live on half of their monthly salary. They need a savings plan to augment their pension retirement payments. The typical savings plans that supplement the pension are the Keogh, TSR, and after-tax investment programs. There's the Keogh, which is only available to partners, and the TSR, which is Kaiser's 401k plan. These are both taxed at ordinary income rates at your top marginal bracket upon distribution in retirement. What you should do also is start an after-tax investment program. This is much more tax favorable. Contributions come out tax-free, and the growth comes out at long-term capital gains rate, half the rate of tax that you'd normally be paying. We help our clients set up these accounts through our company, Winthco Wealth Management. So let's recap your action plan for success. Game plan strategy. First, finish residency. Second, get hired as a Kaiser Permanente associate. Third, ultimately become an SCPMG partner. Fourth, don't be a big spender. Fifth, start a savings and retirement plan. And sixth, line someone up to help you minimize taxes and optimize investments.
Thank you for your attention. If someone is in need of expert tax services, financial retirement and estate planning, investment planning, and portfolio management, we're here to help. Help with taxes through Winther & Company, our CPA firm, and investment planning and strategy through Winthco Wealth Management. Look forward to seeing you. Thanks.